Imagine you need to make a payment. Not just any payment, a very important payment. Maybe you work for a corporation making a major acquisition and a multi-million-dollar payment is necessary to seal the deal. Maybe your son's buying his first home and you've offered to cover the down payment as a gift. What's the safest, fastest way to get that much money from your account to his? Maybe you work at the financial institution where these clients hold their accounts, and they've reached out to you for guidance. The clock is ticking. If the funds don't reach the recipient in time, there will be significant consequences. Not only do these payments need to be made as quickly as possible, the senders and recipients need absolute confidence that the payments are final and the funds are guaranteed. What do you do? Financial institutions, or FIs, need a mechanism to make critical, time-sensitive payments like these with guaranteed finality, both domestically and internationally. They also need a mechanism to settle up with each other as a result of their own and their customers' transactions. To do this, they use the Canadian Payments Association's Large Value Transfer System, the LVTS, which clears and settles about $39.5 trillion in payments every year in Canada. Owned and operated by the Canadian Payments Association, or CPA, the LVTS is critical to Canada's economy, not only as a means to safely send large payments, but also as the key mechanism by which the Bank of Canada implements its monetary policy. It's Canada's electronic wire transfer system for Canadian dollar payments, used to send final, irrevocable payments between participating CPA member FIs across the country. FIs use the LVTS to provide wire payment services directly to their customers, including governments, businesses, and consumers. Through these services, FI customers can request wire payments to other customers. Of course, wire payment services at each FI are branded with different names. A customer wouldn't ask their branch to send an LVTS payment. They'd request a wire payment or use the name of the service offered by their own FI. Customers choose this payment method for critical, time-sensitive, or large-value payments since LVTS payments are fast, final, and the funds are guaranteed. But while customer payments account for approximately 60% of the volume in LVTS, they only represent 20% of the value in the system. LVTS is a wholesale system used by participating FIs to send inter-FI payments to cover their obligations and for settlement transactions. These are payments made from one FI to another to settle amounts owing between them as a result of their customers' activities. Wire payments, retail transactions, credit card payments, and securities trades. In total, inter-FI transactions account for approximately 80% of the value in LVTS. High-volume, lower-value retail payments, like point-of-sale transactions, online payments, direct deposits, pre-authorized debits, and checks, are cleared via the CPA's Automated Clearing Settlement System, or ACSS. At the end of each day, the ACSS calculates the total amounts owing between financial institutions as a result of their own and their customers' retail payments. And FIs use the LVTS to make payments to settle that day's retail clearing balances. Although credit card transactions and securities trades are not cleared via CPA systems, LVTS payments are also used to settle amounts owing between FIs as a result of these transactions. So what is it that makes the LVTS so attractive to customers and FIs alike? The strong risk controls built into the system. Every LVTS payment is exchanged between participating FIs in real time and is required to pass strict LVTS risk control tests. Each LVTS payment is also fully backed by collateral pledged to the Bank of Canada by participating FIs. Before an FI is allowed to participate in LVTS on any given day, they are required to pledge sufficient collateral to the Bank of Canada to guarantee their payments. This collateral usually consists of low-risk liquid assets, such as government-backed securities, for example. The Bank of Canada approves and determines the value of the collateral provided by each of the participating FIs. The LVTS risk controls ensure that sufficient collateral is pledged to cover each and every payment made that day, even if one participating FI were to go into default, thereby ensuring the stability of the system and the finality of payments. Before LVTS, FIs exchanged wire or telex payments with each other but settled them using paper debits. This was risky business for both FIs and their customers. If one FI failed, payments that had been exchanged during that day could be reversed, potentially creating a domino effect with other FIs failing as well, wreaking havoc in the payment system. This is what is called systemic risk, and preventing that risk was one of the primary reasons for developing LVTS. Since its creation, the LVTS has continued to contribute to the growth and stability of the Canadian and international financial sectors. It also plays an important role in 3 of Canada's other systemically important clearing and settlement systems: the Continuous Linked Settlement System, or CLS, the Canadian Derivatives Clearing Service, CDCS, and the CDSX. CLS is a global settlement system for foreign exchange transactions. It connects financial centers around the world which serve as anchors for the trading of 17 different currencies between certain FIs. In a typical foreign exchange transaction, a buyer purchasing one type of currency pays for the purchase using another type of currency. CLS was created to reduce settlement risk in foreign exchange transactions, which is the risk that a buyer could pay the seller the currency it is trading without receiving the currency it purchased, because of the different time zones in which the currency must settle. CLS reduces this risk through direct links to settlement systems in the currencies it settles. When CLS began operations in 2002, LVTS assumed the role of the link that enables Canadian FIs to participate. The CDSX is Canada's clearing and settlement system for debt and equity securities, such as bonds and common stocks. It was implemented in 2003 to risk-proof securities trades, which are typically very high in value transactions. In CDSX, securities are not physically exchanged between the buyer and the seller. The transfer of ownership is recorded electronically, and the securities are frozen in the system, which allows for efficient and cost-effective processing. A secure funds exchange takes place at the end of the day via LVTS and the CDSX account at the Bank of Canada. The Bank of Canada acts as a settlement agent for CDSX, since a private sector FI acting in that role would be too risky. A private sector FI going into default would leave everyone engaged in CDSX in a precarious position. Having the Bank of Canada act as settlement agent mitigates this banker risk, since the Bank of Canada won't initiate any LVTS payments for CDSX settlement unless there are sufficient funds in that account to begin with. The Canadian Derivatives Clearing Corporation is a central clearing counterparty in Canada for exchange-traded derivative products, such as options and futures, and also settles using LVTS. There are 4 key players in LVTS, each of which plays an important role in supporting its operations: the CPA, SWIFT, the Bank of Canada, and LVTS participants. Let's take a look at each of these parties and the roles they play. The first and foremost key player is the CPA, the owner and operator of LVTS. This differs from clearing arrangements in most other countries, where the high-value system is usually operated by the central bank. With this in mind, the CPA carries major responsibilities for LVTS. The first of these is the administration of the system. This includes running LVTS on a daily basis, ensuring the security of the system, keeping the system up to date and compliant with legal requirements, coordinating the various participant groups, publishing rules and guidelines, providing ongoing training to participants, and improving the system as necessary. The second key player in LVTS is SWIFT, the Society for Worldwide Interbank Financial Telecommunication. SWIFT provides the payments network over which LVTS participants exchange payment instructions and also provides monitoring of the network for payment processing. SWIFT is also responsible for overall management and maintenance of the standard message types, or MTs, that are processed through LVTS. The third key player in LVTS is the Bank of Canada, which plays a number of important roles. From an operational perspective, the bank is a participant, just like the other financial institutions taking part in LVTS. It must prepare, submit, and reconcile its payments on behalf of its customers, such as the Government of Canada and other central banks, in the same manner as any other FI. The Bank of Canada is also responsible for monitoring settlement positions of the participants, as well as determining which instruments are eligible to be pledged as collateral for LVTS. Earlier, we mentioned that the Bank of Canada also uses the LVTS to implement monetary policy and control inflation in Canada. Here's how. During a typical business day, FIs that participate in LVTS send payments back and forth to each other through the system. At the end of the day, some FIs will have sent more value in LVTS payments than they've received, while others will have received more value than they've sent. Since LVTS participants are not allowed to have a negative LVTS balance at the end of the day, FIs in a negative or short position will need to borrow funds until the next day to settle their obligations. FIs in a positive or long position can either deposit those funds overnight at the Bank of Canada or lend funds to one or more FIs who find themselves in a short position on a one-day overnight basis. The Bank of Canada sets a target for the overnight interest rate on these loans and deposits. The target for the overnight rate influences the interest rates charged by FIs to their customers for other short-term loans and mortgages, so the Bank of Canada chooses a rate it believes will help keep future inflation low, stable, and predictable. Let's take a closer look. At the center of a 50 basis point operating band is the target for the overnight rate. The bank rate, at the top of the operating band, is the interest rate that the Bank of Canada charges on one-day loans to FIs in a short position. The deposit rate, at the bottom of the band, is the interest rate that the Bank of Canada will pay FIs in a long position that deposit these funds with the central bank overnight. Now let's see this monetary policy in action. FI number 1 is in a long position. They've received $500 million more in LVTS payments than they've sent out that day. They know that the Bank of Canada will pay them 3.75% interest on these funds if they leave them on deposit overnight. FI number 2 is in a short position. They've sent out $250 million more in LVTS payments than they've received that day. They know that they will need to fully collateralize an overnight loan from the Bank of Canada at 4.25% interest to cover this short position. But they have another option available to them. FI number 2 can request a $250 million loan from FI number 1. If FI number 1 agrees, based on its risk tolerance and credit limits, it will send a $250 million LVTS payment for that amount to FI number 2. Typically, FIs charge interest for these loans at or near the overnight rate, and the loans are usually uncollateralized. In this scenario, both sides gain a 0.25 percentage point advantage. FI number 1 will earn 4% interest on the funds it lends to FI number 2, as opposed to the 3.75% it would earn from those funds on an overnight deposit at the Bank of Canada. FI number 2 will only pay 4% on the loan from FI number 1 as opposed to the 4.25% it would pay the Bank of Canada for an overnight advance. The overnight rate typically stays within the operating band, since participants know they will earn at least the bank rate less 50 basis points on positive balances and that they will not have to pay more than the bank rate on loans to cover their negative balances. Knowing the overnight rate in turn influences the rates that FIs will charge their own customers for short-term loans and mortgages. The fourth key player is the group of CPA member FIs who directly participate in LVTS. These include all of the major domestic chartered banks, some foreign bank branches, and other financial institutions. A complete list of the direct participants in LVTS is available on the CPA website, www.cdnpay.ca. These direct participants make LVTS payments on behalf of themselves and their clients. Other CPA members that need to make payments through LVTS enter into arrangements with one of the direct participants. Participants are responsible for pledging required collateral to the Bank of Canada and confirming how it is to be allocated and managed. Payments units of participating FIs are responsible for preparing payment transactions, while cash management representatives forecast and manage their FI's positions during the day, ensuring that sufficient collateral exists to meet that day's payment needs. Participants also contribute to the various CPA advisory committees used to capture feedback on the operation of LVTS. LVTS was designed as an open and accessible system to capture most of the value exchanged daily through the payment system in Canada. There are no minimum volume or value requirements for participation. Any member of the CPA can participate in LVTS, provided it maintains a settlement account at the Bank of Canada, has the facilities to pledge collateral to the Bank of Canada for LVTS purposes, and meets certain technical requirements set out in the CPA's LVTS rules. Each participant must also be a member of SWIFT. LVTS is a credit push system, meaning that the FI sending the payment submits the payment message into LVTS. LVTS payments are individual payments in Canadian dollars and must be entered into the system as individual payment messages. Multiple payment transactions cannot be batched or bundled together into a single bulk payment message. This would not be practical in LVTS, as each individual LVTS payment must be fully backed by collateral, and every payment has real-time finality and certainty of settlement. The two SWIFT message types, or MTs, that are processed through LVTS are the MT103 and MT205. As you can see, the majority of payments settled through LVTS by volume are MT103 payments or customer or corporate client payments, such as mortgage closings or time-sensitive or large-value business transactions, for example. But the majority of the value in the LVTS is reflected in MT205 payments, which are FI to FI payments to offset their obligations. LVTS payments can be initiated a number of ways, depending on the services offered by individual financial institutions. The average consumer sending an LVTS payment at the retail level would typically visit their local branch, where they would request a wire transfer. Businesses and corporate clients that have access to their FI's online payment solution might have the ability to submit payment instructions to their FI via the FI's web portal. The CPA doesn't play a role in setting FI prices for LVTS services. Each financial institution establishes its own pricing structure for LVTS payments, just as they do for other products and services. Before sending an LVTS payment for a customer, the sending institution must first ensure that enough funds to cover that payment are available in the account of the customer initiating the payment, or that credit is available. The debit to the customer initiating the payment will be processed immediately. The funds will be removed from the customer account before the LVTS payment instruction can be released. Once availability has been confirmed and the debit has been processed, the payment instruction is released by the sending institution via the SWIFT network. All payments are also scanned for anti-money laundering and anti-terrorist financing purposes in accordance with Canadian and applicable international law. SWIFT receives the payment message from the sending participant. If the information in the payment message meets the criteria established by CPA for LVTS payments, SWIFT will hold the original message and make a copy of certain fields which it passes to LVTS. The only fields from the payment message that are relayed to LVTS are sending and receiving FI, amount, value date, and currency. This is the minimum information required for LVTS to perform its risk control evaluation of a payment. No client information regarding account numbers or remittance information is provided to the CPA, so privacy and confidentiality between the customer and its FI is maintained. If the payment passes the risk controls, LVTS assigns a Payment Confirmation Reference Number, or PCRN, and sends an authorization message back to SWIFT. SWIFT forwards the message to the receiving FI along with the PCRN and generates a notification back to the sending FI with the PCRN. Once a payment has been approved by LVTS, it is final and irrevocable, and the receiving FI is required to provide credit to the beneficiary before the end of the business day. However, credit is typically provided to the beneficiary in near real time. If a payment does not pass the risk control tests, SWIFT will not pass the payment on to the receiving FI and will generate a rejection notice to the sending FI. The processing of payments between LVTS participants takes place in a matter of seconds, regardless of where the FI is located in Canada. Full end-to-end time between the payment request and the beneficiary receiving the funds will be influenced by a number of factors, including whether the payment is formatted properly. LVTS is very efficient in its use of collateral. On an average day, only $15 billion in collateral is required to settle $155 billion worth of payments. Participants can send payments through LVTS using one of two equally secure options. Now you'd think we'd call these Option 1 and Option 2, but we call the options Tranche 1 and Tranche 2 in finance fancy speak. Both tranches provide real-time finality of payment to the receiver, as well as guaranteed same-day certainty of settlement. So what's the difference between the two tranches? It's the way in which the sending participant allocates collateral to guarantee the payments. LVTS offers the flexibility for each sending participant to choose which tranche they want to use based on their own assessment of the receiving participant's creditworthiness. Two important factors must be considered by the sending participant in choosing Tranche 1 or 2, risk and cost. Tranche 1, the defaulter pay scenario, is a zero-risk option that involves high collateral costs for the sending participant. Every payment sent via Tranche 1 must be fully collateralized by the sending participant alone on a dollar-for-dollar basis. For example, to send a $100 million payment to another participant via Tranche 1, the sending participant must first allocate $100 million of the collateral it pledged to the Bank of Canada for that day to Tranche 1. Remember, once a payment has been approved by LVTS, it is final and irrevocable, and the receiving FI is required to provide credit to the beneficiary before the end of the business day. Well, by using Tranche 1, the receiving participant completely eliminates the risk of unexpectedly having to cover any payments if the sending participant goes into default and can't meet its obligations. Less than 2% of the LVTS payments, representing about 18% of LVTS daily value, are sent using Tranche 1. This is mainly due to the high collateral requirements. Tranche 2 is a limited risk option that offers lower collateral costs for the sending participant. It's a survivor pay scenario, where the responsibility for providing collateral to back payments is shared between all of the participants in LVTS, including the Bank of Canada, kind of like the Three Musketeers, one for all and all for one. Tranche 2 payments involve bilateral credit limits that the participants extend to each other, to indicate the exposure limit one participant is willing to accept from another. Requirements for Tranche 2 are determined on a daily basis via several mathematical formulas set out in the CPA rules. These calculations ensure that there is always sufficient collateral available to cover any losses in the unlikely event that one participant should go into default. Primarily because of the lower collateral cost to participants, Tranche 2 is used for processing over 98% of LVTS payments, representing roughly 82% of daily value. The real benefit of this two-tranche approach is the flexibility it offers to participating financial institutions. On a daily basis, each participant can adjust its approach to meet evolving business needs. Let's take a closer look at the daily operations of the LVTS. The system is operational from 11 p.m. on day 1 until 7:30 p.m. on day 2. There are 4 distinct cycle states, or periods, within an LVTS cycle. From 11 p.m. on day 1 to 12:30 a.m. on day 2, the cycle state is initialization. Within this cycle state, participants who are involved in CLS-related payment processing for foreign exchange trades get ready to become active in LVTS. They pledge the required amount of collateral and confirm how much will be assigned to tranche 1 at the beginning of the cycle, a process known as apportionment. LVTS automatically assigns tranche 2 collateral based on the bilateral limits the participant has established and confirmed for that cycle. The Bank of Canada provides valuation for the collateral, and LVTS tells the participant whether they have sufficient collateral value to meet their minimum requirements. At 12:30 a.m., the CPA changes the cycle state from initialization to open for payments processing. Any participant who has indicated their participation and confirmed their collateral information may now begin to exchange payments. Between 12:30 a.m. and 6 a.m., LVTS is typically used to process CLS-related payments only. Participants can send any type of payments during this time, but will typically wait until around 5 or 6 a.m. before they begin to exchange non-CLS payment messages. FIs that are not involved in CLS-related payment processing become active and complete their collateral arrangements by 7:45 a.m. and must be ready to begin payment processing by 8 a.m. Payment exchange continues until 6 p.m. when the CPA changes the cycle state to pre-settlement. This is the deadline for participants to send customer payments, but participants typically implement an earlier cutoff time of 4:30 or 5 p.m. for their clients to ensure that the payments are qualified and can be released to LVTS prior to 6 p.m. During pre-settlement, participants other than the Bank of Canada attempt to flatten their multilateral net positions by exchanging inter-FI payments, MT205s. Flattening means bringing their net position as close to zero as possible. The FIs will trade in the overnight markets later to cover the amounts they owe each other. Even though they can borrow funds from the Bank of Canada overnight or let the bank hold excess funds on deposit, they will typically find a better rate in the market. At 6:30 p.m., the CPA changes the cycle state to settlement started. No more payments are processed after this point. LVTS is zero-sum, meaning that the sum of all debits and credits in the system must equal zero. The FIs have already begun this process by attempting to flatten their positions during pre-settlement, and the Bank of Canada completes the process by making a single credit or debit entry for each participant on its books. Participants who end up in a negative position at settlement must arrange for a loan from the Bank of Canada to cover the amount. This loan will be paid back the next day through LVTS with interest. Participants in a positive position at settlement must leave the funds on deposit with the Bank of Canada overnight. The Bank of Canada will repay the balance with interest at the start of the next LVTS cycle. When the entries have been made for all of the participants, the Bank of Canada advises participants that settlement has been completed, typically around 6:45 p.m. A strong legal framework underpins the operation of LVTS. Let's take a look at the key components: the LVTS bylaw, LVTS rules, and the Payments Clearing and Settlement Act. The LVTS bylaw defines and enables the operation of LVTS by the CPA. The bylaw also lays out the responsibilities of the participants with regard to the irrevocability of payments, the finality of payment to the recipient, and the timing for making funds available to the recipient. This bylaw is approved by the federal government. The LVTS rules describe the practices associated with the day-to-day operation and administration of LVTS, such as technical requirements and allowable message formats to ensure consistency of processing. Unlike the bylaw, which remains relatively unchanged once enacted, the LVTS rules evolve as the payments landscape changes. The LVTS rules can be amended by agreement of the CPA Board of Directors and are reviewed by the Bank of Canada under a Memorandum of Understanding in place between the Bank of Canada and the CPA. The Payment Clearing and Settlement Act gives the Bank of Canada responsibility for oversight of designated systems, those which are considered systemically important to Canada. LVTS clearly falls into this oversight designation. Since the Bank of Canada has designated LVTS as a systemically important system under the Payment Clearing and Settlement Act, the CPA is required to conduct an annual review of control procedures in place for LVTS operations. The CPA contracts a third party to perform this audit and communicates the results to the Bank of Canada. The Bank of Canada can request changes in LVTS rules, procedures, or even in the system itself if it feels that such changes will reduce systemic risk. The LVTS bylaw and rules are available on the CPA website, www.cdnpay.ca. We hope you've enjoyed this module and that you've learned a few things you didn't know about our large value transfer system. If you'd like to learn more about LVTS, please visit the CPA website Act and Rules section, where you can find more information on the LVTS bylaw and operating rules. The answers to many frequently asked questions are also available in the FAQ section of the CPA website. If you have a question we haven't addressed, please feel free to contact us, and we'll be happy to provide you with the information you need. You can reach us by email at info@cdnpay.ca. or by phone at 613-238-4173.